Welcome back to the Future of Investing. Today I'm going to be talking to Professor Bruce Greenwald, who is a distinguished macroeconomist and an investor with First Eagle Funds, but perhaps best known as the keeper of the flame of value investing and Ben Graham. It was Ben Graham, an academic at Columbia University, who came up with value investing back in the 1930s, and Warren Buffett, among many others, took his class in value investing at Columbia, which is now taught by Professor Greenwald. Buffett himself recommends Greenwald's class as a great way to learn how to make money, and so his views are going to be very interesting. Just as one matter of full disclosure, I should mention that I'm a former pupil. I took Professor Greenwald's value investing class about 10 years ago, and before you ask, he gave me a B, and that was more than I deserved because the stock I recommended in my end-of-term project went bust not long after. Let's talk to him now. Bruce Greenwald, thank you very much for being with us here today. You're often regarded as the keeper of the flame of Ben Graham and value investing at Columbia University. Ben Graham wrote his most famous work some 75 years ago now. What is his relevance for us today and for the future?
I think that its relevance for today and the future is that essentially 75 years ago, Ben Graham was more right about the nature of the development of financial markets and how to get superior financial returns than almost all of the intervening financial theory. So the most important part of that is that Ben Graham had a view that systematically ugly, cheap, disappointing, boring, overlooked stocks were what you wanted to buy. And needless to say, for many, many years, there was a sense that he was off his rocker. Then people began to do systematic studies, and they found out that indeed those stocks systematically outperformed, in violation, among other things, of all the tenets of efficient markets theory, that these simple portfolios of cheap and ugly outperformed the market as a whole by very significant amounts, 3 to 5% over long periods of time. And then the development that I think really underpins his relevance today is that people began to ask, why is that the case? Why do human beings not look at this, buy those stocks, bid up the prices of those stocks, and eliminate these returns? And that led to the whole field of behavioral finance, where we now understand that there are basically three insights that Graham talks about, not explicitly, but really has a sense of, that underpin that long-term outperformance. The first is that people love lottery tickets.
Right, sure.
That in every society we know of, lotteries have done well, and they've been crappy investments. So the lottery ticket stocks, the internet stocks, the China stocks, the Japan stocks, have always been overpriced and underperform. And the corollary of that is that the neglected, overlooked stocks are going to do better. Second thing is people in investing, as in life, irrationally shy away from ugly and unpleasant. And those stocks are oversold. And if you buy them, you do well. And I think the third thing that he understood was that people think they know things with much more certainty than they do. So the whole discourse of the market is going to do something with certainty. This stock is going to do well with certainty. And the reality is that if you really know something in financial markets, you probably know it with 60% probability. What that means is if people think things are bad, they're sure things are bad and they oversell them. And if people think things are good, they're sure they're good and they overbuy them. And that leads to the same extreme. So I think that when you put those behavioral tendencies that are deeply embedded in the way human beings look at not just financial markets actually, but life, you have a really sustainable explanation for what happened. And I think it's that finally caught up with Ben Graham.
Right, that in many ways behavioral finance in the last 20 years just rediscovered
Ben Graham. So first the statistical studies rediscovered Ben Graham. And then the behavioral finance validated Ben Graham. And it's extraordinary that he wrote the book 75 years ago.
Is there anything that we need to update? I mean, one of the complaints that made about security analysis is he was writing about finding really bombed out cheap stocks with a big margin of safety at a point when we just had the worst bear market in history and there were lots of them about. And it was a much harder thing to pull off say in the
Right.
in the 90s. I mean,
It would be truly exceptional if Ben Graham had understood everything
right.
about how to invest successfully in the stock market. He understood this basic tendency of where you've got to go, because even though markets are not efficient in the classic academic sense, I mean, the recent fluctuations in the market just are clearly not rational movements in the prices of stocks. They are efficient in an absolutely unavoidable sense, and a mathematical sense, which is that only in Lake Wobegon can all the portfolio managers outperform the market.
Right.
That the average return for all investors has to be the average return of the market. Everybody owns every asset. The derivatives and the short sales have to net out so that the total return has got to be the return on all those assets. Somebody does better, somebody else has got to do worse. So he understood that implicitly, and he also understood where to look to do better. And that is a good starting point. On the other hand, you really still, even if you look in the right place, have to be good at asking the question in the Ben Graham spirit, what is this stock worth? And he had insights, by the way, that are still superior to what most people do. Start with the assets, because they're the most reliable thing that's there. You don't have to project any future earnings to get the value of assets. You can see buildings, inventory, cash, and so on. Then look just at the current earnings and stay away from the imponderables, which are growth. What that meant was there's a whole universe of stocks that he really just didn't speak to, which are the growth stocks. And they get cheap at times, too. I mean, people decide Microsoft is going to get wiped out, and you get Microsoft at a phenomenal price.
So, for example, I mean, Warren Buffett, literally a student of Ben Graham,
exactly.
Is very well known for buying a number of very big, very successful companies that are not ugly and cheap.
Well, I mean,
using an extension of the philosophy.
Yes, but what he does is, and I think the best example of this is when he buys Coca-Cola in 1988. Coca-Cola has been in a long-term price war with Pepsi. They've destroyed the domestic market. They've just done New Coke. They're buying stupid things like movie studios. And relative to the value of Coca-Cola, at that point in time, it looks cheap.
Right.
And because it's such a good, sustainable company that is reasonably good at reinvesting earnings, it's a good investment to make for the long term. Graham did not understand systematically how to look at those investments, but I think the people who've come after him who have followed, I think, basically two principles. One is always look for things that are ugly in the moment.
Right.
And the second thing is that when you value them, look for things that you know. Don't project profit margins out 20 years or 15 years that you have no idea whether that number is reliable or not. Look at assets, look at current earnings, and what Buffett taught people to look at is the current state of the business and sustainable moats and franchises. And that's something that Graham had not really thought about because he had all these other opportunities. But it's very much in the Graham spirit.